Hello and welcome to our webinar today, Friday. It's a nice sunny day out, a little chilly here in the north, but thanks for everyone joining us today. I know we got a good group today and we appreciate it. As we have been doing every week, we want to give you an update as to where we stand in this current global pandemic, which has certainly filtered its way through the economy. And we continue to see challenges. This week has been somewhat of a little bit of a kind of a flat week. It doesn't seem like lots going on in the markets, although the unemployment numbers were released this morning for the month of April, and so we will talk about those briefly. So as always, I have Beth Foley, Bill Davis, and Matt Aurenz joining us as well from their locations as we continue to practice social distancing and plan on doing so for a while here. So let's jump into our agenda today. Key, really 3 points that we want to talk about. The first one is consumer confidence, and we've got some information to share there that we think is interesting as it relates to consumer confidence. So we'll take a look at that. Smart money, dumb money. This is a theory and where a lot of analysts and economists follow, and they talk about really what are the institutional investors doing versus other investors. So we're going to talk about that. We've got some new data on that. And then we want to roll out and announce to you we've got an opportunity for you as great clients and guests of the firm to work with us in helping our communities. So we'll talk about that at the end. So let's start with consumer confidence. So we'll move on to Beth, I think will kick us off today. And let's talk about consumer confidence, Beth.
This was an article that I came across this week, and I thought that this graph in particular tied in a little bit of what we were talking about last week, which is, it's confusing. If you remember that bullet point from last week, it was like, it's confusing. Why is it confusing? Because there's so many mixed messages coming along. So this graph talks about consumer confidence. So remember, we've been talking about the VIX index, and when we started doing these live broadcasts 3 or 4 weeks ago, the VIX was sitting at about 40, 42 or so, and that the lower the VIX gets, the more positive the 30-day outlook is. Prior to March of 2020, the VIX was kicking along at a number of about 14. It spiked up to 60. It came down to 40, and it's been continuing to drop. So when we talk about consumer confidence, as we're sitting here right now, and we use that VIX index as a measurement, it's sitting at about 27 or 28 this afternoon, which is remarkable considering the unemployment numbers that came out earlier today. So this graph is showing a current dichotomy between consumer confidence and consumer spending. And really the takeaway from this is that people are saying one thing, but they're doing something else. The yellow line here is showing the consumer confidence going back to 2000, and you can see it just drops off completely in 2020. So we're clicking along pretty well, 2015, 16, 17, 18, 19, and then it just drops off a cliff here, as we all know, around March or so. The blue line is, I'm sorry, I've got my numbers backwards. The blue line is consumer spending. The yellow line is consumer confidence. So consumer confidence, consumer spending has dropped off the cliff. It's just gone to, almost negative 5%, where consumer confidence is down, but not nearly as much as what spending is. And a couple of reasons for this. I think that the consumer confidence number, I think there's a little bit of what we learned from 2008 through 2010 built in there. It's just my opinion. In 2008, and you can see the numbers were in alignment back in 2008. It felt horrible. The Great Recession, the money market accounts freezing, people losing their jobs, losing their homes, and so forth. And we never thought we'd come out of that. And remarkably, by 2010 or so, we were back and clicking along and moving into this great bull market. So maybe there's a little bit in the consumer confidence piece of thinking, all right, well, we did it before, we'll do it again, it'll be all right. Consumer spending, however, falling completely, but it's an entirely different situation. People may not have had as much money to spend from 2008 to 2010, but they still had places to spend it. We're looking at consumer spending dropping, not just because of those unemployment numbers or tied to it, is that, we can't go out, we can't shop as much, we're not going out to eat, people aren't traveling, so forth. So consumer spending is down, but I think there's multiple reasons for that. Some that are presented to us that we don't have any choice about. There aren't any places to go spend our money, or as many places, but other, also concern over where the economy is going, which I think is reflected in that consumer confidence index number, which is not as low as I would expect it to be, especially with the unemployment numbers, but certainly nowhere near as what the consumer spending has dropped off to be. So,
well, what's supporting you? What's supporting your point here, Beth, is the savings rate has jumped from single digits, 4 or 5% saving rate to over 13%. And so you see people sitting on cash. And I think partly because what you say, there's no place to go to spend it. We're hearing a lot of that people are accumulating cash because where am I going to go and spend it? So I think that supports that confidence has not dropped near to the level so people are feeling more confident that we're going to come out of this is kind of what I take from it, which is a good thing.
Mm-hmm.
Yeah, I think that it's a good point. And we were talking earlier about, back in that 08, 09 and what was the spike there. So the consumer spending and what happened. And so Matt, maybe you can comment on that. Before we do that, I want to make sure I forgot to mention, if you have a question, if you want to submit it, you can type it in the box there. And we'll see if we have time to take your questions, but we certainly submit it. So Matt, talk through that, kind of that typically how it's followed each other.
Yeah, traditionally they follow each other. I mean, consumer spending is really, or consumer confidence is really what most of the time you can see drives the market. I mean, they're traditionally in lockstep, but I think that rapid recovery there had a lot to do with TARP money, government bailout, the addition to unemployment insurance, those types of things coming out of that financial crisis. And I think even on, to Bill's point on spending, on savings, what we're seeing is as many horror stories as you hear about unemployment. It's about 50% or so of people unemployed right now are actually receiving more income through unemployment insurance than when they were working. So again, a lot of horror stories out there of people who aren't receiving that and are dealing with a lot of financial hardships, but there definitely are people who are not experiencing that. So I think that increased savings rate for some has just allowed them to bankroll a little bit of cash.
Yeah, and I think, Beth, you made that point earlier about 08, 09 was a lesson. We knew that was financial. This is health driven. And so I think we've definitely seen that where, no one likes that it's down the way it is and what's happening. But we knew this was not a financial crisis. This is, a healthcare crisis. And so it kind of makes sense as it relates to how that is. So interesting chart. So Beth, thanks for bringing that to the table.
And Erik, we are seeing a little bit. I think we've kind of spiked on the jobless claims, and we might see a plateau there. In addition, we've seen, Beth brought up the VIX. That's down 8% today, which is a significant move in one day. Our 10-day market is starting to show some bottom and top, so we might be getting that trading range between 23.4 and 24.8 on the Dow. So its deviation has been much less. So you put this confidence factor with what's actually happening in the market. I think that people are getting more positive that we're going to come out of this and get the economy rolling again here pretty soon.
Yeah, and I'm sure some of this too is, it seems like every day they're talking about another company working on drug therapies, working on a vaccine, and now they're talking about, multiple companies working on drug therapies and vaccines, and so we're hearing that as well. So interesting. So if we move on to another topic that we wanted to cover was this smart money, dumb money. So another chart that's got some pretty kind of ups and downs. And Matt, since you handle our wealth management side of the business, I'll let you kind of go over this or start us off.
Smart money, dumb money. Everybody on here has got smart money. So smart money is essentially institutional money, endowments, those types of things. Dumb money is what they would refer to as retail investors. And this is there's actually an index that tracks this, but it's essentially saying, when do people buy and sell? And traditionally what we find is returns that investors experience are completely different than what the market actually returns long term. Especially when you take a look at it compared to institutional or endowment money. And the reason for that is, obviously we've discussed in the past, is emotional investing, but most of the time people are either chasing returns, they have a feeling of euphoric or fear, and so they're buying or selling basically at the wrong time, is ideally what it comes down to. A lot of times, perfect example is we saw a lot of people sell out in retail money at the end of March with great fear that the market was going to continue to drop, and April turned out to be one of the best months. So, the Dow's the S&P's recovered about 30% since it's down March 23rd. So if you were sitting on the sidelines as a retail investor, that's what they're saying is dumb money. Retail investors, again, just traditionally experience a little less return. So that's kind of what this is showing. This is showing the inverse relationship. And so what I find interesting in this is basically saying the confidence that people have in the retail side continues to increase right now. And I think a lot of that has to do more with momentum, more with the feeling things are going to get back to where they were. The economy is going to tick up right away. Government's going to allow people to go out and do their daily business. And institutional money is basically saying, there's a huge disconnect right now between earnings, fundamentals, corporate profits, and what's actually going on in the marketplace. So, again, a perfect example is we see Disney report earnings this week, down 60% in earnings, and they suspend their dividend, and the stock price is up about 9% in 3 days. So a lot of disconnect there, and I think, do institutions always get it right? No, but there's a reason for these charts, and so we're just paying attention to that as well. Again, a lot of data at this point.
Yeah, and I think
I would add something to that, and that would be the algorithmic trading that the institutions now do. You see that as the yellow line was going down so rapidly, the algorithms were going off and they were buying. So that's why you see the opposite effect. So as you had the retail sell-off, the institutional buying began, and in those record trading days, you always have someone on both sides of the equation. Someone's selling and someone's buying.
Yeah, and again, this week alone, we talked a little bit about it last week, but we're seeing volume just continue to tick down, and we're seeing the market continue to tick up. Even like the Dow, for example, a $1 movement of any stock in the Dow equates to just shy of 7%. Just shy of 7-point difference in the Dow. Okay, so if Coke goes up by $1 a share, they move the Dow by 7 points. And so what you're seeing is, in days where 10 stocks within the Dow are having a good day and others are flat, it's still pushing the Dow up significantly with nothing to support it, other than the fact that maybe there was some decent news on those stocks. But again, trading volume being significantly low widens that spread, makes it a little bit easier to move the market.
right? Not just as much of a robust market. And I think to what Bill was saying a moment ago, as we move through the second quarter here and start looking at earnings reports and so forth that start rolling in July, you know, I think that's where we're going to see another dip in the markets, because that's going to signal, you know, how deep the issues are for publicly traded companies and their inability to make money in over the course of the second quarter, and how is that going to be reflected moving forward. So I think that when we see this big drop in value toward March 23rd, we may see push that number again when we get into July and start seeing earnings reports coming in there.
Yeah, those are good points. Yeah, this is interesting, Matt. You mentioned it, how inverse they are, and you look at this, and this is obviously only for a couple of years, but you go back even into history, and it really is opposite a lot. You know, we've seen these as well with which relates into mutual fund money going in, money leaving, and you know, it tends to you know, be doing the wrong thing. So a lot of money's leaving when it's down, and a lot of money's going in, it's already at the high, and they should have gone in when it's down, and they did exactly the opposite. They didn't buy low and sell high, they bought high and sold low. So
I make one more point on this. What I think is actually good too is Vanguard and Fidelity came out with a report that actually talked about retail money not selling out this time. They really haven't seen the sell, which to me says I think a lot of investors are getting good advice, or just saying that happened really fast, or just, again, with this confidence increase, just basically saying there's no point in selling. We believe that this is going to come back. Government intervention happened really quick. So I think some of those components have actually helped people stay invested, so they're not experiencing the sitting on the sidelines watching money disappear.
Yeah, if we think back to 2008 and 2009, it took a while. We talked about this before. It took a while back in the Great Recession for government intervention to step in and really help. And the lesson learned this time was get it in. And so those programs, what are we looking at, kind of going into the fourth iteration of stimulus right now under discussion in Washington right now. So having that quick of a response, I think, has certainly helped confidence as well. Get us through this.
Yeah, it's important. We've talked about over the few weeks is that the reaction and how quick, you know, it did get they got the money into the system. It certainly assisted there. We have a question about, I think it goes back to our previous slide, but do we have the same trend data for business spending, assuming it may have a steeper decline? Well, there's a chart for just about everything. So I know we get, you know, dozens and dozens of charts, right, with a lot of information. But that would be interesting to look at business spending. Does anybody have any comments on that?
The only comment I have that is I already saw that and made a note to see if we can find that this week. Maybe we can share it next week.
Yeah. So,
I actually saw one article recently. It doesn't really speak too much to it, but it was questioning people who in business, you know, applying for the business relief loans, the PPP loans, getting those loans, but actually their businesses being forced to stay closed. So how could they actually use that money? Mm-hmm. And that was going to be a big concern for them. So they're receiving relief from the government, but they couldn't actually operate. So I would assume that the spending in business has declined significantly, but I don't know if it has anything to do with confidence, but just an interesting point.
Yeah. And the unemployment numbers. So anything we want to comment there? That was released this morning. I know it's probably not over because we talked last week about, you know, there could be kind of another wave of unemployment, as well as, you know, the payroll protection program and folks that received this money, you know, they had to keep, in order to have that money be granted to them, basically a free loan, you know, they had to keep people employed on the payroll. And I think that's through June, the end of June. And then, there'll be layoffs beyond that. So any comments on the numbers?
Well,
we've seen this week?
I think we're ready to flatten the curve on unemployment as different parts of the country begin to open up and bring people back to work. I think that we're a little underestimating where we're at, and I think the published numbers around 14.6% unemployment. I believe that number's closer to 20, and Great Depression number was 24 point something. So we're approaching that Great Depression number. But I think we're about to flatten that curve, just like we're getting ready to flatten the coronavirus curve.
I think that goes to what we've been saying, that it was initially spearheaded by a health crisis and not an economic crisis. So, the numbers are huge. I agree with Bill that just through the difficulties of people being able to apply for unemployment benefits or choosing not to, or underemployed rather than unemployed, that the number is closer to 20%. But as in Detroit, we know that manufacturing opened up today. The big three are going again. That we're going to see the jobs are there. They just have to be allowed to go and get them and do them again. So it is going to take a long time to work that number back down again, but we might see it start moving down quickly. And to Bill's point, that unemployment spike maybe flattening and starting to decline a little bit as people go back to jobs that are waiting for them. It's not a lack of jobs, just not being able to do them right now.
What do we think on the recovery? Is it a V? Is it a U? Is it a Nike swoosh? Is it a W? Do we know?
We don't know. I'm going with W. I think we're going to have a W as we see people going back to work, and like at the in the Tyson plant today, the Tyson plant in South Dakota reopened, and they had 1,000 people of new diagnoses of the coronavirus there today. So I think we're going to see some of that, which could cause a W in recovery.
Another question, it's about the unemployment number, which I think is a good question. Are college graduates who begin looking for a job in the current unemployment number? I don't think they are, I don't believe.
I don't think so.
Because it would consider who was employed, right, and filed for unemployment. So the way they would be is if they had some sort of part-time job and they were able to file for some sort of number. But the way I believe it's calculated, and if anybody on the panel knows, it's obviously unemployment. So you're not employed, or you were employed and now you're not employed and you filed.
Right, but there's also a way to calculate those people who are seeking employment.
Yeah.
There too.
Yeah, it's unemployment claims is what that is. So no, college students would not be included.
Yeah. Yeah. Good. All right. So let's move on and talk about some things that we want to talk about here, our takeaways. So an economic shift is coming. This is an interesting thought process, I believe. And we got this from one of the Charles Schwab economists, at least in some information that she had shared this week. And so I know, Beth, that you were studying up on that.
It's speculating that we could see a shift in the makeup of our economy. It was only in the 1980s that the U.S. economy started shifting from manufacturing-based to consumer spending-based economy, and that's really what we've been relying on for the strong growth in our economy since the 1980s. And the Liz Ann Saunders and another organization are speculating that maybe we're going to shift back to a manufacturing economy. So manufacturing over housing, inboarding. So we've had offshoring of manufacturing and so forth. We may see that inshoring again as we've learned disruption of supply lines, difficulty of trade policies when one country is shut down and another one isn't, that a confidence level could bring manufacturing business back to the U.S. In their reports, they're breaking down periods from World War II on up into the 80s, and depending upon how long those unemployment numbers stay high and people are not working or underemployed, that we may see some of those savings rates stay up, less consumer spending, so that we're more dependent upon a manufacturing economy again. So we'll see. That could be one of the shifts that we see as a result of the past 3 months.
Yeah, it's very interesting. So emotional investing is not a strategy. Don't bring emotion into it, right, Bill?
Yeah, it's very difficult to do, and we've talked about this for many, many years, that when the market's going its best, we feel very powerful positive emotions, and when the market does what it did on March 20th or throughout March, we feel negative emotions, and we just can't act on those. We need to stay the course. Whatever the investment plan that we put together, that course was what we need to stay, and we can't sell low and buy high.
Right. And it's the, the fear of missing out as the market is growing. And it's like, oh, I'm missing out. It's going to keep going. I want in. So it's either, I fear missing out, or I've just got to get out. And we make those long-term plans, in a calm. We always say, this is a safe place to have these conversations where we're removing emotions from the conversation. That's what we try to do with you and all of our clients, as far as trying to continue to make those decisions based upon data and long-term plans and what the goals are, and not just what the emotions are at that particular moment.
So we've talked for weeks. We've talked about volatility is not over, and this emotional side of it. And there's a lot of unknowns still, because it's the health side of it. Not really knowing if, as they're opening up the economy in these markets, do they come back? Does the virus come back or not? But is volatility over, Matt?
No, I don't think so.
Nice short answer.
I don't think so.
So there's still going to be more volatility. I mean, I think we want folks to know that, right? April was, hey, we'll take it, but there's still some volatility ahead, probably.
Yeah, it's a good thing that my hair is going gray and not falling out, because I'm ready to pull it all out, Erik. You look at this markets of tabs, it kind of makes you chuckle. I mean, in good news, it's going up. I think the biggest thing is we don't want to have this false sense of comfort that it's just going to continue to go up.
Yeah.
I think stick with the investment plan, to Bill's point, is going to make sense. The good news is we are seeing uncorrelated assets continue to keep that non-correlation as things have calmed down, which is good. We're seeing pocketed areas recover. I mean, the NASDAQ, for example, is positive for the year. That's good news. So there's definitely some pockets where things feel good, but I think things that we're still watching are going to be, what does oil do? Futures for the month of June, and obviously the volatility. I think there's a lot of discussion. I heard yesterday about a multi-trillion-dollar stimulus package that's number 4 that they're potentially going to propose next week. So I think there's still a lot out there, and I think the government realizes that there's still a lot of work to be done. So we're cautiously optimistic, but it's going to be volatile.
Yeah. Wall Street and Main Street can't be disconnected long term.
Yep, to that point, I think it really just comes down to, you cannot continue to have long-term, quarter after quarter, economic loss, right? You can't just keep reporting negative earnings with positive stock prices. So at some point, things are going to have a revaluation. Now, what we don't know, what I think is really the difficult part is, there's definitely a high probability that a lot of these stocks were already oversold, and so some of this rebound that we've seen is really probably more appropriate price correction. It's already there, but a lot of companies aren't even reporting. What do you think your second quarter earnings are going to look like? They're just saying, yeah, it's going to be bad. And I think that frustration creates for analysts, we don't know how to price your stock. So they're all over the place. I mean, the ranges of what analysts are saying on a particular stock are pretty big. And so I think that will continue to keep things volatile until we can see some type of baseline trend.
Yeah.
Matt, I have a question for you. So do you think that not providing direction on their company, their stock, their profits, it could also be leading to the lower volume that we're seeing in trading, that analysts, companies are analyzing, those institutional investors are staying on the sideline too because they don't have a clear direction. They're not being given direction. Do you think that might be leading to the low volume?
It could, I mean, and there's always the sell away in May and just kind of hang out in the summer, right? I mean, there's still some of that stuff I think comes to play, but I think people just don't. I think people have kind of calmed down, they've taken a breath, and now they're trying to analyze data to determine where to go next, and it's confusing. So that's for me, I think, part of the volume decline.
Yeah.
But it just
yeah, no, I think it's all good points. It's all kind of somewhat head scratching, like you said, Matt. So a question came in about, I think it's interesting that we'll make this our last question. With all the debt being taken on for funding programs, could you comment on the long-term implications for the investment landscape? Who wants to take that?
Well, our kids and grandkids are going to have a lot of debt to pay back in the future. That's for darn sure. As long as interest rates stay low, we can support the debt level that we've taken on. What will be difficult is 3 to 5 years from now, if inflation starts to creep in and interest rates start to go up, then all of a sudden, and if we were in any kind of a recession, it would be difficult for us to continue to manage and service the debt level that we've accumulated.
Mm-hmm. And that's what we've been saying, that these packages have been great and they've really helped to maybe stabilize things, but they're going to have to be paid for at some point in time, and that's going to be a burden on the economy, on the individuals. So I think it could inhibit growth, certainly in the long term, for equity markets.
Yeah,
and I think you probably should do some long-term tax planning, because probably you're going to see tax rates go up at some point to pay this constant debt. So if not soon.
Yeah, and they said, I heard an economist say a few weeks ago that, we needed it. It needed to be done. The Fed needed to step in, as well as the acts from Congress. It needed to be done, but that also means that they now have, the somewhat of a right to basically say, okay, now how are we going to make this up? So when it comes to, as you said, Matt, tax planning, other opportunities, Roth conversions, things like that, those are things to think about as you're working with your advisors. So, well, let's talk about a program that we've put together here at the firm that we want to help our communities, and hopefully that we can partner together. So we're calling it Together We Can Make an Impact. And what this essentially is that we have kind of two regions that we service a lot of our clients, although we have clients around the country. We're asking that if you want to donate to a charity, and don't forget that this year, as a taxpayer, you can donate $300 to a charity and take it right off the top of your taxes. So if you're a married couple, that's $600. And you can take it right off the top of your taxes, that could be a benefit, because many of you are not able to deduct your charitable deductions now because you can't itemize. And so you'll see more information coming out on this, and you'll see an email. But we wanted to announce it here that we want to partner with our clients, and so if you make a contribution, we're going to match 25% of your donation up to $75 per charity. This program is going to go through June 15th. So you can see the four organizations: the Food Bank of Northern Indiana and Beacon Health Foundation has a COVID-19 fund. That will be for our area in Northern Indiana. And then we have our Detroit metro area with Gleaners in Detroit, say. And then if you are from a different part of the country or different part of a region, if you have a local charity that you want to contribute to, by all means do so. and we'll send you all the details on how you submit your receipt, and then we're going to put a match in there of your donation. So we hope everyone on the call will participate. We think it's a great opportunity for us to step up and really help those in need, that need the food and that are struggling right now, and to help those on the front line. Also, I want to mention that look for an email, and you will be able to find on our website. We're going to have a special webinar coming up towards the end of the month, and this will be on cybersecurity. We have engaged with an expert that has spoken worldwide on cybersecurity. He's been on more than 500 TV programs, including the Today Show, Fox News, CNN, you name it, he's done it. And so we're going to have a webinar, and he's going to talk about cybersecurity, how to be safe in this current environment, and things that you can do to make sure that your identity is not stolen. So make sure you take you look for that as well and get signed up for that webinar. I'm going to end with, I want to wish all of the mothers a happy Mother's Day on Sunday. And hopefully the weather's going to be okay, I guess. And for those of you that are maybe down further south, the weather's even going to be better. But we just want to wish all mothers happy Mother's Day from here at the firm. And with that, I'm going to sign off for Matt, Bill, and Beth. Thank you so much. And we'll see you next week, 3 o'clock. Take care.